Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor, and you find me at the desk today for one of the first times in one of these videos. But don't worry Nick, we're going to move into the whiteboard in a minute. Don't you worry about that, I've got lots of figures to share. And in today's video, we're going to be talking about a very easy and safe way for you to earn an average salary completely passive. And I know that if you're watching this channel, that's something that interests you, because we talk about passive income, we talk about working hard, making sure we stay humble, but at the same time achieving that passive income that's going to allow you to live the life that you want to live. Now, before we get into the video, if you could possibly give it a big like, it really helps me out with the algorithm, and I really do appreciate every single one of you who does that. And if you haven't already subscribed, why not consider subscribing? Remember, we don't sell any courses here, we don't do any upsell. It really is just to get the information out to you and give you as much value as I possibly can. Now, today's video, as I said, is all about passive income and how we can create income and how we can basically replicate an average salary with completely passive income. And there's only really, in my mind, one asset class that allows things to be completely passive. Now, property is never completely passive. There's always ongoing maintenance, there's always repairs, there's always things going on with property, which means that it cannot be completely passive. You can make it as passive as possible, but it's not completely passive. But index funds and index fund investing, now that is completely passive, because the companies are run on your behalf, and all you have to do is potentially set up a monthly subscription to your favorite platform. For me, that's Hargreaves Lansdown, and the money will be debited from your account and go into your index funds. Now, why do more people not talk about this? Well, it's not particularly sexy, and I probably couldn't sell you a course on it. But what I can do is show you how anybody can pretty much guarantee themselves a passive income that's going to replicate their salary in a few years. Now, obviously, with its reduced risk profile, it's not going to be overly speedy. It's not going to make you a millionaire in 2 years. I can't promise you any of those things. But what I can do is give you the data and science behind this that will show that over a period of time, investing in index funds is a really smart thing to do. So guys, let's get into the video. Let's start talking about what an index fund is first of all, and how and why you should invest in them. Now, an index fund essentially tracks an index, which is a list of stocks that makes up that index. For example, the FTSE 100 contains companies like AstraZeneca, Barclays, HSBC, Unilever. You'll have heard of these businesses. And essentially, as businesses do well and they become more valuable and their market cap in that FTSE 100 becomes greater, the index fund automatically replicates this. Now, why is that great for you and me? Well, it means that we don't have to necessarily take the risk. We're not picking the stocks. I accept that I'm probably not going to be the best stock picker in the world. I don't know what's going to happen in the future. I think there was a report that said 99% of retail investors over a 15-year period failed to beat an index, and 96% of mutual funds failed to beat an index. So with that in mind, we know, or we can make the assumption, that index funds are a safer place with better returns for us to put our money. Now, I personally completely buy into that philosophy, and I follow that in practice. So at the moment, I'm investing in index funds. I invest in things like the FTSE 100, I invest in an international one, I invest in an all-world, and I also invest in an S&P 500, as well as an emerging markets fund. And I'll go through my holdings a little bit later on in the video. But essentially, I give myself a broad diversification at a very low cost. And remember, because you don't have any analysts picking these stocks, because you have no data being done, it's just literally following the market, they're generally very passive for the banks to run. So the fees are incredibly low. For example, on the Vanguard funds that I invest in, the fees are as little as 0.05% per year. It's incredibly low fees for the investment. So guys, that's what an index fund is, and that's why I choose to invest in them. Basically because they have lower fees and they tend to outperform mutual funds or stock picking. So with those three things in mind, index funds are where I place my money. Now, what wrapper you place your money in is also very important, because there are tax implications to be considered. So this video is really targeted at the UK market. And in the UK, we have something known as the ISA allowance, which is a £20,000 a year investment allowance, which anything within that wrapper, any dividends it produces, any capital appreciation it produces, all of that money that you receive is completely tax-free. Now, this is incredibly important when we're looking at how we can essentially replicate an annual salary with passive income like that, because we now only have to try and achieve the net figure rather than the gross figure. So what I'll do is I'll quickly have a look up what the UK national average salary is and what that means in terms of take-home pay, and then we're going to be able to back engineer exactly how much you're going to need in index funds and how long it's going to take you if you were to save a certain amount per month to achieve that goal. Now, as I said, this isn't it's going to be sexy and it's boring and it's slow, but I guarantee if you're like me and you enjoy investing and you start to get the bug of watching that passive income hit your account, you're going to want to double down on this as fast as you possibly can and get to that target as quickly as possible. So let's have a look at exactly what a UK national average salary is today in 2021. So the average UK national salary, I've just looked it up. Nick, if you could put the image up on the screen, is currently £31,000, and that means a take-home pay of a little over £2,000 a month, £2,061 a month. So we're going to use that as a basis for our target. And if you're enjoying this content, if I could remind you to give it a like, it massively helps me out with the algorithm. And also, I have sorted out my collar today. And Nick, put up the images of people talking about my collar. I do apologise to all of you out there. I didn't know my appearance mattered so much, but that has now been sorted. I think what we'll do now is we'll head to the whiteboard and we'll start talking about the ways that you could achieve this. First of all, through dividends, secondly, through compound growth, and thirdly, through something known as the 4% rule. So let's go to the whiteboard and let's run through all that information. Let's go. So guys, as I was saying, let's assume we're using an ISA wrapper and let's go to the whiteboard and talk about how much we would need to have invested in dividends in order to make this work. Now, index funds, they pay out dividend ratios. If you look at the Vanguard All World at the moment, it's about 1.2%. The S&P 500 is about 1.4%. The FTSE 100 is running at around 3.8 to 4%, something like that at the moment. But you can find some high income funds that are going to be about 7% as well. Now, what I wanted to do was really highlight how much money and what sort of period of time it would take if you're using dividends and how much you'd have to invest every month in order to get there. Now, first of all, if you're doing £300 a month, in 40 years you'd have the £2 million required for a 1.2% dividend rate to be paying you £2,000 a year. In 29 years, you'd have £600,000 and you'd have enough for the 4% dividend rate to be paying you the £2,000 a year. Only 23 years, and I know it's only 23 years, and it's not very sexy when you're talking about this, you'd have £342,000 paying you the £2,000 a month. So even investing as little as £300 a month, there is no reason that everybody couldn't get a portfolio of over £2 million. Now, I appreciate this isn't the full picture. There's inflation to take into consideration. There's rising living costs. There's lots of other things in this, but I need to give a broad understanding of where we're at. Now, dividends is the first way that you could get this achieved. And as we go up the scale, we can see that £600, 34 years, £1,000, 29 years, £1,666 a month, which is the maximum you can do, £20,000 a year. It's only going to take 24 years to get to £2 million. Only 14 years to get to 600k, and only 11 years to get to £342,000. So really, if you make investing a priority, you can get there in a fairly short space of time. Now, what I want to talk about in this video isn't just the dividends though. I want to talk about the capital growth, because on average, the portfolio is going to grow by about 10% a year, including dividends. So when you reinvest dividends, it's about 10% a year. The FTSE 100 does it, the S&P 500 does it. It's all about 10% a year. Now, we can argue and we can take different snapshots and we can say it was 8% over this year's and it was 9% over this year's and it's 12% over this decade, but ultimately the average is about 10%. So these dividend rates actually mean you're going to have a significant amount of growth beyond that. So this is where something that's known as the 4% rule comes in, and I want to talk about the 4% rule. Essentially, 4% is deemed the safe amount that you can withdraw from your ISA allowance and never really deplete it, either in purchasing power, because 3% are baked in for inflation, or when market cycles go up and down, you'll be unaffected because 4% is very, very safe. So really, if we're looking at a complete and total return and we want to achieve our £2,000 a month income, we only really need to look at this column here to have a completely safe and non-depleting amount of money. Now, you might say to yourself, actually, you don't need it to be non-depleting. You don't mind starting to eat in at this capital later on in life. But let's look at it just as a depleting amount. Well, if you're a couple and you're investing the maximum, it's only going to take you 10 years. If you're a single person investing the maximum, 14 years. £1,000 a month, 18 years. That means a 20-year-old starting today, by the time he's 38, would have £600,000 paying him £2,000 a month. I would think that anybody could achieve that. I think that's a fantastic goal. So today's video isn't really about get quick rich. It's not about the promise of gold tomorrow. This is very much about the get rich for sure and make sure it comes through in the long run. Now, this is as passive can come. The companies that run on your behalf, index funds, are as passive as it can possibly be. I've got index funds, I do absolutely nothing. You might want to rebalance them once a year, but beyond that, they're low fee, they're low risk, and ultimately they're pretty good return. So guys, let me know in the comments, are you investing in index funds? Is it something you're interested in? For me, I've already doing the maximum I can every year into my ISA because I believe that this sort of income here, actually for me, as a higher tax rate payer, is the equivalent of earning £4,000 a month because I'm going to pay at least half of it in tax. So it's a fantastic return for me, well, after tax. So guys, let me know in the comments if you're investing in index funds. I massively appreciate absolutely every single one of you. Like this video if you haven't already. Give me a subscribe if you're interested in this sort of content. I will update you on the subscriber dividend portfolio very, very shortly, probably at the end of next week. And on top of that, we're going to be bringing to you my own personal stock portfolio in the coming months, and I'll show you what I've been investing in when it comes to index funds. But guys, have a great weekend. Thank you so much. It's been Friday, and I will see you again soon.